Hi, I'm Rob Morocco, here today on behalf of ETF Market Canada. Today I'm with Alex Lee, Head of Canada ETF Product Strategy for Franklin Templeton. Alex, many of our viewers want to know, where's Bobby the Labradoodle? Is Bobby, we see him on the phone with clients with his headset. Where is he today?
He's probably by the lake. It's summer, so my wife probably has him in lake somewhere.
Next episode, we got to get him on.
Absolutely.
Well, taking it back to our conversation, the focus of our conversation today, really looking at the overall fixed income market. Alex, where do we find ourselves at the moment from a macro perspective when looking at fixed income and the overall fixed income market?
If we look at the fixed income market, both Canada and US, first half of the year, both were negative. And I think part of that was just the repricing of number of rate cuts that were expected. We've seen robust labor data as well as inflation that's quite sticky. So that has delayed the rate cuts, especially in the US.
Let's take maybe a step back and look more at monetary policy from a global perspective. What are your thoughts?
If you look at, for example, ECB, European Central Banks, Bank of England, they started their cutting rate cycle this year, but Bank of Japan conversely actually went the other way. They've actually raised interest rates, which has created some volatility recently. But, I think from a global perspective, a lot of major central banks are signaling a cut.
Looking at the Franklin Canadian Ultra Short-Term Bond Fund, FHIS, give us an overview. What is the product?
The objective is to, try to preserve capital and generate attractive yield without taking too much interest rate risk. We've maintained so far a credit average. It's meant to be an investment grade average, focusing on the Canadian fixed income market.
One element of the fund I really find interesting is the risk management element to the fund. How does that work? How are you implementing that element?
Our portfolio managers have been quite patient about not taking on too much duration risk, even within the space. We've had money market or bankers acceptance to help mitigate some of the interest rate risk. What we're trying to do is make sure that, again, minimize volatility, but generate an attractive yield. With the yield curve that's inverted, we don't really have to take a lot of risk to generate those returns. So we've been very conservative on managing duration risk.
Tell me about the team that manages FHIS.
So it's managed by 3 portfolio managers. We have Naveed, Sabrika, and Brian that manage the fund, but it's also part of a bigger team within Calgary. One thing I'll mention is that Franklin Fixed Income Team in Canada is part of the global team. So we have access to credit research, trading capabilities, and other resources from a global perspective.
Alex, with additional rate cuts expected here in Canada, why should investors consider anything other than long-term duration bonds?
I'll start with how much risk are you comfortable taking, right? Because long duration bonds does have upside potential, but also has that downside potential like we saw back in 2022. Even with rate cuts, we could see yield curve move differently. So, on a parallel shift, of course, longer duration would benefit more. But let's say you have something like a bull steepening, which means duration or yields would drop more on the short end versus the back end. That actually would still favor the short end of the curve. If we do have a recession or drastic economic downturn, then long duration would provide better upside potentials.
Are there fixed income strategies that we've discussed here that really help a client when they're thinking, or a client should consider rather, when constructing really that balance in their portfolio?
If you're benchmark against something like a FTSE Canada Universe, you may need some corporates and governments as well as duration just to keep up with the benchmark. Something like FHIS is going to be very consistent with low drawdowns and low volatility. So it's going to serve that purpose. But if you are looking at potentially higher returns, we consider things like our Core Plus strategies, which have actually generated a strong alpha against the benchmark.
Final thoughts when we look at the overall macro environment for fixed income and where we're going, and thoughts that investors should be thinking about.
If you're still sitting in a lot of the cash, I think it's time to put that towards work. Again, I think depending on how much risk you want to take, we have a lot of opportunities within Franklin. So the ultra short, I think it's a good segue. But I think if you are thinking more long-term, we think aggregate bonds do make a lot of sense. What we've seen so far month to date is that bonds actually did well to hedge some of the equity risk that we've seen. So, that is something to consider. And we're not in the same environment as we were back in 2022, where rates were moving up quite drastically. We're expecting more rate cuts potentially. So I think considering those things, investors should consider fixed income as part of their portfolios.
Putting the cash back to work.
Exactly.
All right, Alex. Thank you so much for joining us.